Are monthly dividend ETFs really better than quarterly ones? Or could choosing wrong cost you thousands in potential returns? Welcome back. Today I'm answering the question I get asked most: JEPI and JEPQ with their monthly payments, or quarterly payers like SCHD and VYM. By video's end, you'll know exactly which payment schedule best matches your financial goals. I'll even reveal how Harry created a dividend strategy that delivers both consistent monthly income and impressive long-term growth. Building a successful dividend portfolio starts with this critical decision. Let's dive in. The key challenge for dividend investors is choosing between monthly dividend ETFs and quarterly payers. Monthly dividends align perfectly with regular bills, while quarterly dividends often come with different investment strategies. Many investors fixate on payment frequency without considering the underlying investment approach, dividend growth rate, expense ratios, and long-term potential returns. This choice isn't just about timing. It's about balancing immediate income needs against long-term dividend growth and capital appreciation. So what's the solution? You need to understand what you're really getting with both monthly and quarterly dividend ETFs to make an informed decision. Here's everything I'll cover in this video. A detailed breakdown of the top monthly and quarterly dividend ETFs. How payment frequency affects compounding and total returns. The hidden costs and benefits of each approach. A side-by-side comparison using real performance data. Practical strategies for different investor types and goals. In the end, I'll show you how to potentially get the best of both worlds. The consistent cash flow of monthly dividends with the growth potential of quality quarterly payers. But first, let's start by examining what monthly dividend ETFs actually offer beyond just more frequent payments. Let's examine the top 3 monthly dividend ETFs, starting with number 3. SPHD, Invesco S&P 500 High Dividend Low Volatility ETF, offers a 3.50% yield with a 0.30% expense ratio. Its defensive sector positioning, 28% financials, 21% utilities, provides stability during market volatility while delivering monthly income. At number 2, JEPI, JP Morgan Equity Premium Income ETF, boasts a 7.95% yield with a 0.35% expense ratio. Using an option strategy on low-volatility S&P 500 stocks, it's grown to $37.7 billion in assets. A $100,000 investment generates about $662 in monthly income. Meaningful cash flow for retirees. Our top monthly dividend pick is JEPQ, JP Morgan Nasdaq Equity Premium Income ETF, with an impressive 11.83% yield and 0.35% expense ratio. It applies JEPI's strategy to tech-heavy Nasdaq 100 stocks like Apple, Microsoft, and Nvidia. A $10,000 investment would deliver approximately $98 monthly or $1,183 annually. The trade-off? While these monthly payers provide consistent income now, they generally sacrifice long-term dividend growth potential compared to quarterly alternatives. Let's compare them with the top quarterly dividend ETFs to see the difference. Now let's examine the top 3 quarterly dividend ETFs, starting with number 3. VYM, Vanguard High Dividend Yield ETF, delivers a 3.03% yield with a rock-bottom 0.06% expense ratio. With 530 holdings and $55.9 billion in assets, it offers superior diversification compared to monthly alternatives. Its broad sector allocation, finance 23%, technology 13%, provides stability while focusing on both income and growth, delivering a 59.4% 5-year return. At number 2, VIG Vanguard Dividend Growth ETF takes a different approach with a lower 1.94% yield, but emphasizes consistent dividend increases over time. Its ultra-low 0.05% expense ratio makes it one of the most cost-efficient dividend ETFs available. VIG's impressive 64.9% 5-year performance demonstrates the power of dividend growth investing over pure yield chasing. Our top quarterly pick is SCHD, Schwab U.S. Dividend Equity ETF, offering a 4.14% yield with just a 0.06% expense ratio. With massive $65.6 billion in assets, it selects quality companies with strong fundamentals and consistent dividend histories. Top holdings include dividend stalwarts like Verizon, Coca-Cola, and Lockheed Martin. While a $10,000 investment in SCHD generates only $414 annually versus JEPQ's $1,183, SCHD's consistent dividend growth over the past decade means those payments could potentially double within 10 years, something less likely with income-focused monthly payers. For long-term investors, these quarterly ETFs offer something potentially more valuable than monthly payments: substantial dividend growth and capital appreciation potential. Comparative case study: $10,000 investment. Now, let's directly compare these ETFs with a real-world example. If Harry invested $10,000 in both types of ETFs, how would the results differ over time? And we'll be sure to include the critical factor that many investors overlook: expense ratios. Starting with the monthly dividends, let's use JEPQ with its 11.83% dividend yield and 0.35% expense ratio versus SCHD with its 4.14% dividend yield and much lower 0.06% expense ratio. In year 1, JEPQ would generate about $1,183 in dividends, paid out as $98.58 monthly. SCHD would generate about $414 in dividends, paid out as $103.50 quarterly. But those expense ratios matter. On a $10,000 investment, JEPQ's 0.35% fee costs Harry $35 annually. SCHD's 0.06% fee costs Harry just $6 annually. That's a difference of $29 per year, which may seem small now, but compounds over time. Now, here's where it gets interesting. Let's assume Harry reinvests all dividends to maximize the dividend snowball effect, and let's factor in those expense ratios. After 5 years, JEPQ might grow to approximately $17,350, assuming modest 2% price appreciation plus dividend reinvestment, less cumulative expense ratio costs. SCHD might grow to approximately $14,100, assuming 4% price appreciation plus dividend reinvestment and 5% annual dividend growth, less cumulative expense ratio costs. After 10 years, JEPQ could reach around $30,400, with about $350 lost to higher fees. SCHD could reach around $24,700, with only about $60 lost to fees. But wait, if we look further out to 20 years, JEPQ might grow to about $93,000, with about $1,400 lost to higher fees. SCHD could potentially reach $84,800, with only about $240 lost to fees. And by year 30, JEPQ might grow to about $282,000, with approximately $4,500 lost to higher fees. SCHD could potentially reach $283,000, with only about $720 lost to fees. Now imagine if Harry had invested $100,000 instead of $10,000. The fee difference becomes even more dramatic. JEPQ would cost Harry $350 annually versus SCHD's $60. After 30 years, JEPQ's higher fees would have eaten approximately $45,000 of Harry's returns. Meanwhile, SCHD's lower fees would only cost about $7,200 over the same period. That's a $37,800 difference just in fees, enough to buy a luxury car or fund a grandchild's education. This shows something remarkable. Despite JEPQ's significantly higher initial yield, SCHD potentially overtakes it after 30 years due to lower fees, stronger dividend growth, and better capital appreciation potential. And if we're talking about actually living off the dividend income after 30 years, JEPQ might be generating about $33,380 annually, or about $2,782 monthly. SCHD might be generating about $29,200 annually, or about $7,300 quarterly. That's a much closer race than you might have expected. The difference in expense ratios, 0.35% versus 0.06%, may seem small, but it compounds dramatically over decades. But there's one more factor we need to consider. What happens during market downturns? During the recent market volatility, JEPQ declined by 14.03% year-to-date as of April 2025, while SCHD declined by 8.52%. This suggests that the quarterly payer might offer better capital preservation during tough markets, which can be just as important as yield for long-term returns. So what's the practical takeaway here? Let me share 3 distinct strategies based on different investor needs. Strategy number 1, the pure income approach. If you're already retired and need consistent monthly income to cover expenses, allocating a significant portion of your portfolio to monthly dividend ETFs makes sense. A portfolio of JEPI, JEPQ, and SPHD could provide diversified monthly income that aligns with your regular bills. For example, with $300,000 invested equally across these 3 ETFs, you could generate approximately $2,321 in monthly income based on current yields. That's meaningful money that could cover many retirees' basic expenses. Strategy number 2, the growth and income hybrid. If you're still in the accumulation phase but want to start building an income stream, consider a 70-30 split between quarterly and monthly payers. For example, allocate 70% to growth-oriented quarterly payers like SCHD, VYM, and VIG, while putting 30% in monthly payers like JEPI. This gives you some regular income while prioritizing long-term growth. Strategy number 3, the Dividend Ladder. This is actually what Harry implemented, and it's brilliant in its simplicity. He created what I call a dividend ladder by investing equal amounts in SCHD, VYM, VEG, and JEPI. Since the quarterly payers distribute dividends in different months, SCHD in March, June, September, December, VYM in March, June, September, December, VIG in April, July, October, January, plus JEPI. Paying monthly, Harry effectively created a portfolio that provides income every single month of the year while still emphasizing quality and growth. With this approach, Harry gets more income in the months when his quarterly payers distribute, creating a sort of dividend paycheck that's larger in certain months, similar to how many people receive larger paychecks during certain pay periods. So which is better, monthly or quarterly dividend ETFs? It depends on your specific situation and income needs. For immediate cash flow needs, monthly dividend ETFs like JEPI, JEPQ, and SPHD provide predictable monthly income. For long-term wealth building, quarterly dividend ETFs like SCHD, VYM, and VIG offer lower expense ratios and stronger dividend growth potential. Key takeaways: 1. Consider both payment frequency and investment quality. 2. Watch those expense ratios. Small differences compound dramatically. 3. The best strategy likely combines both approaches based on your timeline. 4. Remember that dividend reinvestment accelerates compounding regardless of schedule. If you found this helpful, like and subscribe for more dividend investing insights. Check out my SCHD versus VYM comparison video that's on your screen now.